Hello everybody, welcome back to another valuation investing video, and today in this video I'm be going over Oracle stock, in which this company has just done the unthinkable with their recent earnings report yesterday. And as we can see here, the stock is up almost 40% in one day, and this company is now almost $1 trillion. So the market cap of this company is nearing the $1 trillion club at $956 billion. But we're going to be getting into the earnings report of this company, and then looking at the financial health, and then finally getting into the intrinsic value calculator that I've created to get a fair value price for Oracle and to see if we should be buying after this huge rise in stock price. So with that being said, taking a look here at Oracle, the stock is at $335. The 52-week low is at $118. So this stock has really been a great return if you bought it in the past year. You're making a lot of money, and this stock continues to rise. As we can see here, if you don't know what Oracle is, Oracle develops and provides database software, cloud infrastructure, and enterprise applications like ERP and HCM to businesses for managing their data and operations. Their main products include the Oracle database, cloud services for business, and business applications that streamline functions such as finance, customer service, and supply chains. So this company offers a bunch of pretty diverse company, but there's one main product that is really helping the stock go insane today, and that is with their Oracle databases. So let's get into the earnings report for Oracle. As we can see here with Oracle, we can see the stock is up obviously a lot, but as we can see here for the first quarter of its fiscal 2026, we can see that they actually fell below Wall Street expectations for both the revenue and EPS. So you're wondering, they missed on both revenue and earnings per share for this quarter. So why is the stock up, and why is it up over 40, almost 40% today? We'll be getting into that a little bit later, but first let's take a look at this recent quarter where they reported $14.9 billion of revenue, slightly below the $15 billion expected by analysts. Also, the adjusted earnings per share came in under 1 cent of expectations, $1.47 reported, below $1.48 expected. So looking at this at face value, you say, why is this stock up so much? And I would tell you, I don't know why, but there's a main reason for this, and this is mainly with the guidance. As we can see here, the CEO came out saying we expect Oracle Cloud Infrastructure to grow 77% to 18 billion this year, and then increase to 32 billion, then 73 billion, 114, then 144 billion over the next 4 years. So they're expecting huge growth with Oracle Cloud Infrastructure, almost doubling every single year in the next 4 years. So this came as a big surprise to basically everybody in the stock market, and this is one of the biggest beats I've ever seen. If this does come true, the best guidance I've ever seen out of a company in the past, ever since I've been in the stock market. This is one of the best I've ever seen. Oracle's optimistic revenue outlook came as it raised its remaining performance obligations, or the total value of contract revenue Oracle will deliver in the future. So this is another big thing with that guidance. We can see in their contract, basically their obligations with their customers, with their contract revenue, we can see they signed 4 multi-billion-dollar contracts with 3 different customers in quarter one. And the big thing here is, look at this, resulted in the company's contract backlog increasing 359% to $455 billion in its first quarter. So that's how much backlog they've had. They increased 359%. So this is insane growth, up to $455 billion. So this is the expected contract revenue in the future with all these other customers. And as we can see here, Oracle also said that the company expects to sign up several additional multi-billion-dollar customers, and for its RPO to exceed $500 billion. So they're expecting their future revenue to amount to over $500 billion. That doesn't mean the revenue in 1 year, say in the next 5 years, but they're expecting a huge amount of basically revenue to be coming in. It says we have signed significant cloud contracts with who's who of AI, including OpenAI, xAI, Meta, and many others. So this company is really getting a lot of customers, a lot of new contracts, creating a lot of new revenue, and this is insane right here. 144 billion in say 2030. That's going to be insane if that actually happens. Who knows if it will necessarily happen, but with the amount of backlog, I definitely do expect this to be at least 120 billion, anywhere from 120 to maybe 175 billion, I'm believing. And with Oracle Cloud Infrastructure, Oracle, about 75% of their revenue comes from their Oracle Cloud Infrastructure. So that is a pretty large segment of Oracle, which is why this stock is really going up a lot. Taking a look at the importance of Oracle Cloud, we can see an Oracle Cloud data center is a physical facility that houses the computing, storage, and networking hardware for its OCI, which is the Oracle Cloud Infrastructure. So these centers are the foundation of Oracle's cloud computing services, providing the infrastructure for customers to run basically everything, databases, applications, and stuff like that. Unlike the traditional data center model, which is often a single monolithic building, Oracle's approach is based on a global network of interconnected data centers. So this is really helping their customers with AI getting huge, and they need a lot more space and a lot more computing power. This is really going to help them increase that computing power with Oracle, and that's why they're getting so many contracts for their Oracle Cloud. Taking a look at the global network and architecture, Oracle's data centers are deployed in a globally distributed network of regions. Each region is localized geographically. So this company is really doing very well for this upcoming AI boom, and it's already booming, but in the future, a bunch of companies are spending a lot on AI. So with that being said, if they want to spend a lot on AI, they also have to spend a lot on cloud and infrastructure in order to even withstand the amount of power that is being used with AI. So that is why Oracle is about going to generate a lot of money and why the stock is just going insane. And taking a look here, the key services on offerings for these cloud services is infrastructure as a service. This includes core services like compute, machines, storage, and networking. Platform as a service, they also have software as a service, provides a suite of business applications. Distributed cloud, a unique aspect of Oracle's data center strategy, is the ability to extend its public cloud services into a customer's own data center. Also, security and sustainability, Oracle places a strong emphasis on security and sustainability in its data centers, which I believe is the reason for why this company is getting so many contracts. It's just basically Oracle is the best at this, basically, and a lot of companies need to have these cloud services to withstand the power of AI and to continue to grow. So they're going to be spending a lot on this company. Taking a look at the financial health of Oracle, we can see here, we actually only get 5 out of the 7 key metrics. With the forward P ratio, this is a good thing I like to look at for the valuation. I want this less than 30, however, it's at 49, but it doesn't make sense because this is taking into account future earnings growth. The company is expected to grow 20+% in the future now, and with that market average at about 25, the market average growth rate's at about 10%, so it's not too far out of the question for a 49 forward P ratio. I do think it's a bit rich, but it's if what the CEO did say does come true, then this is definitely worth it. Taking a look at the ROIC, which is the return on invested capital, I want to see this greater than 10%, and it's at 10.9%. So it's not too bad, but 10.9% isn't huge compared to big tech companies like Google, Meta, all these big tech companies, Microsoft. Their ROICs are a lot higher than Oracle, but I do expect in the future this will definitely increase because in the past, if we take a look at the growth rates, only 8 and 7%. So taking a look here at the past, we can see the company really hasn't been growing, wasn't growing a lot from basically 2012 all the way to 2021. We had very slow growth, but ever since 2022, the increased demand for their cloud infrastructure, we've seen a lot of growth. In the past 3 years, the revenue is growing at 11% in the past 3 years, with the net income growing at 23%. So their profit margins are doing better and their revenue is increasing at a faster rate. So they're accelerating that revenue, and we're going to expect this to really accelerate even faster in the future. So that is good for Oracle. Taking a look at the shares outstanding, they've been buying back at about 2%, which I like. If a company buys back a lot, that means that as us investors will actually own more of the company. As we can see here, they're buying back at a good rate. I don't like it over the past 3 years, they've increased shares, but the company has been soaring a lot. But normally I want to see them buying back shares. But honestly, with a company that's expected to accelerate their growth in the future by a fast rate, I'd rather them honestly just keep the shares the same and not buy back, because in the past, this company wasn't growing a lot with the revenue. So honestly, with this chart, this shows me that the management looks like a pretty good management company with Oracle. Because, like I said, from 2012 to 2021, we saw basically no growth. So, when a company's not really growing a lot, you want to see them buying back shares, because at least they can return some better investments to the shareholders. And when a company's not growing fast, it's hard to reinvest back into the company and make a lot of money. So, with that money, might as well buy back shares to also return to investors and maybe pay dividends. But with this, we can see exactly from 2012 to 2021, they bought back a bunch of shares. But ever since the revenue started to reaccelerate, they started to increase shares. I don't necessarily love that they're increasing shares, but I do like, actually, maybe I do like that they're increasing shares, because as they increase shares, they're going to make a lot of money. And with that money, they're going to reinvest it back into the business. And if they do expect this company to really grow at this fast rate, to basically 20+% each year, I do expect this could be pretty good for Oracle. So with that being said, actually I do kind of like that they're increasing shares and not increasing it by a huge margin. So this is actually not bad to me for the past 3 years that they're increasing shares, since they're going to be growing at a very fast pace and they're expecting that to happen. Now, taking a look at the debt to free cash flow, this technically is undefined because there is no free cash flow with Oracle. And the reason for that is, I think, because of the CapEx spending this company is doing. They're really spending a lot on CapEx, and they increased their CapEx spending, I think, to 35 billion. It was either 25 or 35 billion this year. So they're really increasing that spending a bunch for future growth. So it's nothing to really be too worried about, honestly, with the debt to free cash flow. But the debt is still a little bit high compared to the amount of net income they have, but it's not bad. And also, take a look at the expected EPS growth rate. Analysts expect this company to grow at 21% for the next 5 years each year. They expect the revenue to be almost 22% and the earnings per share 21%. So this company is really expected to grow at a very fast rate. So this looks very good for Oracle for the future. And with that being said, I'm going to be going to my intrinsic value calculator in order to get a fair value price for Oracle stock today. Taking a look here at my intrinsic value calculator, I have to do future assumptions in order to get a fair value price. So the first thing I have to do is for the bear, base, and bull case. For the bear case, we're going to be very conservative. Base case, I'm going to do what I believe this company will likely achieve. Bull case, this is going to be what on the high end I think they can do. So for the bear case, annual revenue growth rate, they do expect to grow at about 20 to 25% for the next 5 years. But honestly, for the bear case, I'm going to go, let's do 12%. I know that seems very low, but I think worst case scenario, it is 12%, but I think base case is going to be a lot higher than that. Base case, I'm going to put, for the base case, let's do 20%. That might be a little bit low, honestly. We could do 25%, but I think 20%, a little bit conservative, isn't too bad. Now for the bull case, let's do 28%. Say this really does start to grow this company, more and more companies get contracts, 28%, I think isn't necessarily out of the realm of possibility. Now taking a look at the margins, we can see here, with the margins, it's been consistently at about 20 to 30%. Right now, it's at about 22%. So with that being said, I think bear case, we see it at 20%. Base case, I think this increases to about 24. Bull case, I think gets up to 28%. Now for the future PE ratio, for a company growing 12%, I think Oracle deserves a PE ratio of probably 22. Base case, if you're growing at 20%, I think you deserve at least a 30 PE ratio, maybe even higher. Let's do 32, and for the bull case, let's do 42. Now for the shares outstanding, I believe for the shares outstanding, say this company buys back at about, maybe they actually increase shares over the next year. Say they increase it at 1%. Say for the base case, they don't do anything to the shares. Bull case, they buy back at 1%. With that being said, at today's price, I think you get for the base case a 3% return. With the bear case, you get negative 15%, bullish case 20%. So I think base case, this is a little bit conservative compared to the CEO's assumptions, but we shouldn't necessarily take the CEO as, yes, this is definitely going to happen. But say it grows to 25%, which I think is right in basically in line with what I think the CEO does expect to happen. And future P ratio of 35, I honestly think you can make about a 9% return, so about market average today. So with that being said, I think market average today, you could potentially make an okay return, 9 to 10%. But if you believe this bull case, I think you can make 20%. So thank you guys for watching this video on Oracle. I think you can make about 7, maybe 6 to 10% return on your investment if it does happen like the CEO says for the upcoming years. So thank you guys for watching this video. Please subscribe, hit the like button, comment down below, and thank you guys for watching. See you.